All right. Welcome, everyone, to the first episode of TradeView Live in 2026. Thanks for your patience. We're having a little technical difficulties getting started. Happy New Year. And I'm your co-host, Ben Tracy. I lead strategic business development at Vizion, joined here by Kyle, our CEO and co-founder. Kyle, Happy New Year.
Happy New Year.
Happy New Year to the audience. I hope we haven't passed the statute of limitations for continuing to say New Year.
Well, maybe it's a preemptive Chinese New Year happiness.
Yeah. Preemptive Happy Chinese New Year, which we'll talk about. But welcome, everyone, new and returning guests to TradeView Live. For anyone that's new, we'll go through a quick explainer and then go through some of the latest trends in supply chain. So, Kyle, what is TradeView?
It's the industry-leading trade intelligence platform from Vizion. We have more coverage than any other platform, with seeing 57% of all ocean freight worldwide, 3 times more than any other platform. And that's at the individual shipment level. That's not like aggregate rolled up. This is shipment by shipment, which means we've been able to profile 1.5 million companies. We also leverage our access to bookings to give 90-day trade forecasts, map out supplier and product networks, and we've built in an AI researcher to help deliver your customized insights.
And you mentioned bookings. So why don't we give a quick background on where all this data comes from?
Yeah. So we've connected independently and built a lot of custom to Vizion and special data connections to more than 270 different sources. That can be ocean carriers, port terminals, booking platforms, AIS data, you name it, we're likely pulling it in and making sense of it. And a moment ago, I mentioned that we also forecast the future leveraging some of this data. And that's because a lot of the data we get access to is bookings from bookings platforms. And so how can you forecast the future with that? Well, we see the moment the booking is placed, and that's typically 3 months before it actually arrives anywhere in the world. And so with that information, we're able to then forecast volumes of arrivals for different locations and products and companies worldwide.
Great. So let's talk about what's happened in the last 4 weeks since we had our last episode. We'll go into some of the numbers that we have pulled up here for everyone to see. But on our last episode, we began to call some predictions for 2026 by our wonderful guest, the Oracle, Santosh at Dynamo Ventures. Santosh said a few things that have actually already happened. One of them being Venezuela. There were comments made about a potential acquisition of an ocean carrier. It looks like that's potentially going to come true this year. But we've had everything from Greenland to Iran to tariffs to the Suez Canal, many of the predictions we talked about. So anyone who hasn't listened to that last episode of 2025, go back and listen to it, because I think we were on track, and potentially the rest of our predictions are also on track to come true in 2026. But as far as the numbers, we report on this every 2 weeks, and we've seen dramatic ups and downs beginning in April of last year, when we started releasing these bookings, this signal of shipping demand, of shipping activity globally for U.S. imports, and specifically for the China to U.S. relationship, which has been talked about so much in the last year. So, Kyle, at a glance, what's happened in the last 4 weeks? How does this look as we head into the new year?
Yeah, last 4 weeks, year over year change, global bookings are up, right? Up in a pretty meaningful way, 10%, 6.3, 7.3, 15.8. I'm looking at these top right corner of the top right table over here. Let me turn my laser pointer on. That's always a fun thing to use.
Oh, there you go.
Here we go. Looking around up here. So what we're seeing is year over year change, pretty strong volumes for all global bookings. Now there's a bit of a week over week dip change here that's happening at the end of December, which expected. That's a quieter time of year for week over week, but you can see year over year, it's actually above trend. So global bookings are up. Now, U.S. import bookings up-ish in the week of January.
Most recently, yeah, but otherwise basically flat, if not a little bit below the year before. So we'll talk a little bit about what we're seeing as an emerging trend, which is the pre-Chinese New Year rush. So far for U.S. import bookings overall, that hasn't quite taken effect. Maybe in the most recent week, we're starting to see that take effect. And specifically for China to U.S., which would be the main focus here for pre-Chinese New Year rush, it looks like that really has been quite low, at least as far as year over year. We're starting to see that creep upwards from where it was earlier in December, but in comparison to the year before, very low. Now, keep in mind, when we compare last year's December bookings and early January bookings to the year before that, Chinese New Year was earlier, is the point that I'm making. It's a little bit later this year, so that could be a contributing factor to this year-over-year decline.
And we'll get into more detail about that in just a moment. We got a special slide talking about that. But digging in a bit more with the global bookings, you can see again that red line on the far left here being 2026. We're starting stronger in some sense than any other year on the chart. So going back all the way to 2023.
Wow. Yeah.
When we look at it as just U.S. import bookings, I'd say on trend for this time of year compared to the past 2 years, a little bit lower, but I think we are suspecting we're going to start seeing a surge in bookings through the end of this week into next week and the week after, because those are actually when the window starts to close for any pre-Chinese New Year bookings, because it's such a late Chinese New Year.
Yeah. So when we see that precipitous drop in previous years, that would be a little bit later, maybe closer to week 8, week 9.
And what's interesting is you look over the last 7 years. 7 years ago, the Chinese New Year is one of the earliest times it ever is in a year. And so we're actually seeing this march, right? Because 2023 New Year was sooner than 2024, which is sooner than 2025, et cetera.
Yeah, exactly. So I think we want to go ahead and dive into this in a bit more depth. And the main reason is what I've been reading, Kyle, what you've been reading from mainline publications, from industry publications. I'm not going to name any names here, but a lot of the influential shipping industry news sources that we turn to are telling us that there is no pre-Chinese New Year rush right now. And maybe they're looking at different indicators other than bookings. But the comments when you look at
looking at rates right now,
looking at rates, the comments that when you look at the headlines is that the pre-Chinese New Year rush has failed to materialize, despite factory shutdowns, declining week-on-week demand. This is a question of what sort of strength we're going to see into 2026. But in fact, Kyle, in TradeView, we're seeing the opposite. Yeah. We're seeing data that disagrees with that comment that there is no pre-Chinese New Year rush right now.
And we have these right here bulleted with the green check. So week 2 and week 3 volumes for China exports for booking volumes are up 18.8% above 2025, indicating strong early demand. Week 3 was a peak at 827,000 TEUs for Chinese export bookings. That's the highest week 3 in the past 7 years. And again, Chinese New Year is quite late. It's the 8th week of this year. And the factory closings are usually a 2 to 3 week window kind of surrounding that date. So what this is really pointing to is the rush hasn't quite happened yet. And we also have a little chart here in the top right. So if you want to look at 2025 compared to 2026, the typical factory closings were like last week of January, first 2 weeks of February last year. But this year, we're seeing it being more of starting in the second week of February and going to the beginning of March.
Right.
It's the peak, if there is going to be one, well, as we're predicting, there will be a bit more, has not quite happened yet.
But certainly that jump in December is that just that in that lower right, that bar quite above. It looks like almost any month in 2025, going all the way back to what is that, February or March rather?
And today's only January 22nd, so we have a solid week still left of January. And so this is just showing data up until yesterday for January in 2026. And it's already on track to be about the same as last January or higher.
And to dive specifically into the additional trade lane where we can look at Chinese New Year, pre-Chinese New Year rush, that would be Asia to Europe. So a primary driver in that. What you see on the far right in that blue line at the end of 2025, so just a few weeks ago, is that initial rush. And in fact, it's above what 2024 would have been at the same time. And this is now beginning to happen when we fast forward into 2026 and that dark red line, well above 2025 numbers and approaching even 2024 numbers.
I'd also comment that, there are a few different qualities that I might be getting conflated in understanding what's happening with rates right now, what's happening with Chinese New Year rush. There's also questions, has the rush been somewhat delayed because of the later Chinese New Year? Has the rush been delayed because of a wait and see as it relates to the Suez Canal reopening fully?
And potentially even just what's happened in the last week with threats that were made for an additional 10% tariffs on European goods, with all the sort of instability that comes with what could have been a dissolution of the NATO agreement altogether, with the conflict that was going on over Greenland. Now, based on the speech and based on the indications yesterday, it looks like that crisis has been averted, that we might not be looking at additional punitive tariffs on Europe. And, it opens up the door now for demand to return. But we do want to look at the Suez Canal, right? Because we actually see different carriers approaching this differently to begin the new year and in the end of last year. Right, we have Maersk actually conducting one of the first transits, and we have other carriers like CMA backing off of their previous statement that they would return to normal routing within the Suez Canal. Now, what do you think this will do, Kyle, for transit times, for different reliability indicators in terms of performance on these trade lanes? How does the Suez Canal factor into how these metrics might change in 2026?
Yeah, this is an interesting one because the carriers are probably going to leverage this to their benefit to some extent, because they're having this, this battle between the opportunity of the Suez route to shorten transit times, potentially, then also drop rates for that. There is a question around capacity, and capacity being a hot topic because there's so many new vessels becoming available and capacity increasing by pretty substantial amounts. Mm-hmm. So the carriers are going to have to be walking a fine line right now, because the demand for freight is, there's questions, just as, some news outlets are saying that, there's not as much demand in 2026, and the Chinese New Year rush is showing that. We're not sure about that just yet because of what we said with the Chinese New Year. So what is the volume? What's the demand prediction for this year? But that demand versus supply and capacity, also the rates, the carriers are going to be trying to play with the Suez situation as much as possible to keep rates up and manage that supply and demand as much as possible.
Yeah, limit how much new capacity is actually added to the market overall.
Yeah, yep. and leverage any headline or concern around security, et cetera, to keep going around the Cape if they can, or to not fully return to the Suez Canal as soon as they had been saying. pointing a lot to the instability in Iran with the protests and the horrendous news of the death of so many protesters.
Yeah, absolutely. Now we're foreshadowing a little bit on our next episode of TradeView Live, which will be diving specifically into insurance and risk and how that's been evolving with things like the Suez Canal over the course of the last year and a half. So more to come on that. We'll have a special guest that will help us dive deep into that topic of insurance and risk posed to these shipments and how that's evolving.
And
So
one last note around kind of Chinese New Year and Suez. This topic of this week pre-Chinese New Year rush, this narrative, it's really conflating three separate issues. It's conflating the Red Sea route uncertainty, which is the majority of the issue, I would say. It's conflating not really being sensitive to Chinese New Year is extremely late this year. And third, there is some genuine trade softness, so some of that softness in demand, but that is being overhyped right now, I think, for headlines. That, trade softness might only account for 10 or 20% of the pre-Chinese New Year rush narrative that you're hearing. But we'll continue on, Ben.
So let's dive a little bit more into performance. Overall, what we've seen in key trade lanes in recent months. This is for what, the last 90 days?
I believe so, yes. And so, Trans-Pacific, because you can have some express services coming from far Northeast Asia to the US West Coast, you can get some sub 2-week transits, but I'm thinking more of express lanes like from Zim that are doing about 2 weeks and being effectively the fastest path from Far East Asia to the US West Coast. But there is a range of service levels, costs, transit times, and the performance status has been somewhat mixed. Part of that has been due to blank sailings. The Far East to US has seen the vast majority of blank sailings recently. And that's just for managing capacity, managing rates, therefore, as well. Now, the Asia to Europe, the performance status has been somewhat critical. As many of you know, there were quite a few delays on the inland side for North Europe due to winter weather. That has started to see some relief, but it was adding a pretty meaningful amount of time to transits once we were getting off vessels, but also a little bit of a backup at vessels at North European ports because they can only be serviced so quickly and containers can only be cleared so quickly. Everyone else is doing pretty well, all things considered.
Yeah, as far as trade lane performance, which we wanted to offer a unique preview on this. We'll be doing a lot more reporting on trade lane performance, specifically by carriers ahead of TPM. We know a lot of shippers are negotiating their contracts right now with carriers and volume commitments on key trade lanes. So what we've done is we've taken all of the 2025 data in TradeView, 40 million shipments, something like that, and been able to actually dissect not just the overall transit times, but specifically by carrier and when there are delays, on average, how delayed were the carriers all of last year. We began this reporting at TPM in 2025, but we'll be releasing a lot of complementary performance audits in 2026. So if this slide interests you, if you're having active discussions now and you're trying to decide your lane allocation, your allocation by carrier, you're seeing lots of different offers in terms of performance, in terms of rates. We've got data that might be of interest.
And just to correct a number you threw out there, last year we have about 130 million TEUs worth of shipments in TradeView.
Oh, great. Oh, maybe I was thinking just the Trans-Pacific trade lane. It was just 30 million within that. Yeah.
Some details on transshipment hub performance as well, not just looking at it by understanding performance at carrier, but also what kind of performance are you seeing at transshipment hubs by carrier as well. So this is some insights into what's happening in some key ports such as Singapore. So the port of Singapore down here in the bottom with looking at Costco, MSC, one as well. Containers we were tracking going through there and seeing some average dwell times of ranging about a week in Singapore. So a little bit longer on the dwell time there. So when you're making some considerations of where your transshipment might be happening for the service you're selecting, these are some considerations.
And the reason why we want to show this is we see a lot of service reliability metrics go out there. We have some that have been able to use AIS data to even calculate their own transit times port to port. What that doesn't tell you is the container dwell at the transshipment port. So this is specifically measuring, because we're following individual containers as well as ships. And so this measures when the container was unloaded from the first vessel at the transshipment port, how long until it made it to that next vessel to move on to hopefully its final destination or its next transshipment port. And so that transshipment dwell is a key influential metric on that overall transit time. When you're choosing a service string to go from Asia to Europe or to go from Asia to the US, and you're going to have to go through a specific transshipment port, pay attention to what those ports are. We have very different indicators of average container dwell, whether you're going through one or the other. And that's a unique metric only offered in TradeView. So I get excited when we talk about trade lane performance by carrier, not just to give you that overall transit time as we were seeing on the previous slide, but to be able to dive into specific transshipment hubs.
And we typically are talking about HS code increases and decreases, focus more on imports to the US. But we were seeing some interesting movements more at a global level. And so we wanted to surface that this week. In terms of major increases, a lot of increase in terms of mineral fuels and oils. So 8 to 12% increase for HS code 27 and its children. But also, machinery, mechanical appliances, electrical machinery, a lot of capital investment going on with these types of volume increases of 4 to 5 to 4 to 6%.
Yeah, absolutely.
Plastics and organic chemicals as well.
And I think if this trend continues specifically in that Asia to Europe trade lane, I'll want to follow up this slide with a specific HS code breakdown for the Asia to Europe booking increases we've seen. Which HS code specifically are we seeing that increase due to? So is it also some of these same ones we're seeing mineral fuels, machinery, electrical machinery, and plastics? Or are there other goods that are going to begin going into Europe more than others?
And again, this is any port of lading, any port of destination, but this is a 4-week average of bookings. And so many of these shipments that we're telling you about these increases have not arrived yet. So this is forward-looking insights into these volumes of these types of products should be increasing in inventories sometime later this quarter.
Yep. Brian had a really good question on, not to go back to the topic we were just discussing, but one step back, if you want to go back to the transshipment dwell.
Sure.
Brian asked, have we seen an improvement in transshipment dwell specifically for Maersk and Hapag since the Gemini agreement began? And this is a question we've been asked. It's potentially a little too early to tell, just as far as how that might be able to move global averages, not only for Maersk and Hapag as carriers before the Gemini agreement was fully implemented, but also benchmarking them against other carriers in that same time period. That's specifically, I think, what we want to look at is not just the improvement for those carriers overall, but are they actually beating transshipment dwell for other carriers now that they're in this Gemini alliance?
Not speaking specifically to transshipment, but more generally an analysis we've been doing over the past, say, 90 days. I will say that the Gemini alliance appears to be living up to its promises of being the most reliable services out there.
Yeah, certainly early reliable schedule reliability and high-level performance indicators are favorable for the Gemini alliance. We might need just a little bit more time to be able to dive into something as precise as transshipment dwell for those two carriers.
But it's a great question, especially with that comment. So much is about hub and spoke with that alliance. So transshipments have to go smooth.
Brian, if you're going to be at TPM, hopefully by then, which would be about a month and a half from now, we've got enough time to report specifically on transshipment dwell for the Gemini alliance. So,
or even at the Manifest conference within a few months from now.
Yeah, in a couple of weeks. Any more to add on the HS code booking trends? We see a few other industries. I know furniture was talked about a lot over the summer. We saw that tremendous drop that we reported on. I think it was in August and September. And it looks like that decline has continued in the most recent 4-week average. Furniture and bedding seeing the biggest decline globally.
Yeah, and that's an interesting one because, furniture, bedding, toys and games, apparel, footwear, these are also all kind of sensitive to the holidays, right?
Mm-hmm.
These are the gift categories. So some of these declines are a response to just being post-holiday season, since it's a 4-week rolling average. But I feel like the increases are actually the more interesting one right now, because those are some categories that you wouldn't be expecting to see that much of an increase on.
Exactly. Great. Well, we're right on time here. Thank you all for joining the first episode of TradeView Live in 2026. We'll be back in exactly 2 weeks with our special guest, focusing on specifically insurance and risk, and diving in, following up on some of these other topics we brought up today. See you all in 2 weeks.
Cheers, everyone.
Bye-bye.